Hi there, this is David Hillier and I'm going to be giving a very quick video on how to use real data to calculate the average return and standard deviation of a security. Now the material that I'll be using is based on chapter 9 and section 9.3 of my book Corporate Finance, and if you want to read more about this, then you can take up the book. Now, what I'll be doing is using real data. So the material that's in the book is more, explains the theory and explains a lot more than what I'm going to do in this video, which is effectively show you how to actually go about and calculate the average return and the standard deviation of a security. Now, we're going to start off and we're going to look at data today. So I'm recording this on the 13th of May 2014, and we'll look at DAX. DAX is the German stock exchange index for the largest companies, and we want to look at a specific company which is in DAX. So we can click on components, and from the components, let's just take the first one. You can see here, these are all the very largest German companies. You can get this data from ft.com, from Reuters, from Bloomberg, or if you're at a university, you can get this data from proprietary data sets like DataStream or the such like. So we'll go to Adidas, and we're going to the Adidas page. The thing we're interested in is historical prices. And so at the side of the Yahoo Finance page, you see historical prices. And we now have this series of historical prices. Now, in Yahoo Finance, you can choose between daily, weekly, or monthly data. What I'm going to do is I'm going to download all three, and we can look at how daily data is related to weekly data, which is related to monthly data. The start date on Yahoo Finance for Adidas prices is the 3rd of January 2000. And you can see here in this list of prices that you have a number of different prices. You have the open price, the high price, the low price, the closing price, the volume of shares traded, and then the adjusted closing price. The adjusted closing price takes into account dividend changes or dividend being issued and how that impacts upon the price. What we'll be using here is adjusted prices to calculate the returns. So to download this data, you would go down to click download to spreadsheet and then just download it and then import it into Excel. Now I've already done this, and what you can see is I've done it for daily, weekly and monthly data. The data starts at the very beginning of 2000, as you can see here, and the daily data goes up per day, but notice that there's a break for the weekend. The 8th and the 9th is a Saturday and a Sunday where there's no trading, and so you get 5 days of trading a week. Now you then have the weekly data. In the weekly data, you can see it goes up by 7 days, but within any 7-day period, there should be 5 days of trading a week, unless there is a holiday during that period. And then you have the monthly data. Now, given that there's 5 days of trading every week, monthly data would have 20 days of trading in a month. Now, that's quite important to remember that. So we have 5 days of trading in a week, we have 52 weeks, and we have 12 months. Now, from the price data, I then calculate the returns. And if you look at how I did the returns, you can see that for the daily, it's just price at time 1 minus price at time 0 divided by the price at time 0. And we do that for every single price observation. You can see here that we've got daily returns. We do it for weekly. You notice that it's the same formula. It's the price at week 1 minus the price at week 0 divided by the price at week 0. And for monthly data, it's the price at month 1 minus the price at month 0 divided by the price at month 0. So that's us got the daily data, daily return series, weekly return series, and monthly return series. Now the next thing you do is we want to calculate the averages. Now, if you look at my formula here, I've used the Excel formula average, and I'm including the whole of the data set. So there's 3,718 observations, daily return observations in my Adidas time series. And the average daily return is 0.149%. The standard deviation formula is STDEV H4 to H3718. It's the same return series you're looking at. On Excel, depending on the version of Excel, the standard deviation formula may be slightly different, but for compatibility reasons, my version just uses the old standard deviation, but it's a sample standard deviation you should be using. We look at weekly data, well, then you can see that it's just doing the average of the weekly data and standard deviation of the weekly data, and then the monthly data is the average of the monthly returns. Now, that's how you calculate returns and standard deviations, but you'll see here that they're really quite different. So let's say that you've got daily data, and you've only got daily data, and you maybe want to find out, well, okay, what's the weekly return? Well, we know that there are 5 days in a week. So to scale up your returns, you would say, well, it's the average daily return multiplied by the number of periods in the larger period. In this case, it's 5. Now, look at what we've done here. We've just multiplied this by 5, and then you compare it to the weekly. The weekly data is the actual weekly return. This is the approximation of the weekly return by using daily data. And the formula is just the return multiplied by 5, and that's the number of days. But let's say we wanted to find out, well, okay, what's the monthly return using daily data? Well, there are 20 days in the month, so we would multiply the daily return by 20, because that is how many days are in the month. And you see here that the average monthly return using daily data is 2.98%, which is fairly close to the real monthly return, which is 3.24%. So that gives us a good observation of the number of days that you have in a month, and then that you can use that to work out the monthly return. You might want to annualize the data. Now, if we've got 5, if you've got 12 weeks, sorry, what am I saying? If you've got 4 weeks in a month, or sometimes you've got 5 weeks in a month, you've got a total of 52 weeks in a year. 52 times 5 is equal to 260 trading days. And we can use that as an approximation. You wouldn't use 365 trading days, because Saturday and Sunday there is no trading. There's holidays. In every single year, the number of trading days is going to be different. And in every single country, the number of trading days is going to be different. But let's say we want to calculate the annualized return for Adidas. Well, we would take the daily return and multiply it by 260. And you see here that I've got an average annualized return of 38%. Now let's say, well, okay, if it's weekly, there's 52 weeks in a year. Let's find the annualized return using weekly data. You see that our value is approximating to be 37.3%. And what about the monthly return? Well, the monthly return is 12 months in a year, 38.9%. So these are all approximations using daily, weekly, and monthly. And if you scale them up to the annual, then you can get the expected or the average annual return for Adidas, which is actually quite high. We can do the same thing for standard deviation. It's a slightly different formula. The formula we use is the standard deviation multiplied by the square root of the number of periods. So instead of just multiplying it by the number of periods, which you do for the average return or the mean return, for the standard deviation, you've got to multiply it by the square root. So let's say if we want to scale up to from daily to weekly, then there's 5 days in the week. You can see here that our proxy from using daily data to work out the weekly standard deviation is 11.5% compared to 10.09%. If we were to do it to the monthly, it's the standard deviation multiplied by 20 days, or the square root of 20, because it's a square root here. And you can see 23.05% is really quite close to 23.12%. Similarly, if we want to find the annualized standard deviation, we've got to multiply the daily by the square root of 260, because that's the number of days in the year, and we've got 83%. Let's do it for weekly. There are 52 weeks in the year, so it's 0.19 multiplied by the square root of 52.79, and then we do it for the monthly, which is 0.23 multiplied by the square root of 12.8. So a lot, when we work with data, we might just have daily data, but we want to express the returns annualized. And you can see, well, you can do that fairly straightforward. It's just multiply the return by the number of periods, or multiply the standard deviation by the square root of the number of periods to get the larger value. Okay, now very quick run through in terms of how to download data, how to calculate returns, and how to calculate average returns, how to calculate standard deviation of returns, and also how to work between different differencing intervals. Hopefully this has been of use to you. Thank you very much.